You're watching the Mortgage Busters show, and we say it every week. This show is all about paying off your mortgage at a fast rate of knots, but also preparing for retirement. Rain, welcome back to the show.
Great.
How you going?
All right, great to be here. How are you?
Are we getting a lot of inquiry for the thumbprint report?
We are. A lot of people are calling in asking us, hey, what's this thumbprint report and how can we get in contact with our special guests?
Well, what about if we gave that number or give that number out so that we can reinforce the number in the Mortgage Busters system? Yes,
you'll see this number throughout the show. So it's 1300-862-746.
And that number again is?
1300-862-746.
And our special guest star is?
Our special guest today is David Hunt. We had the privilege of having him on our episode last week talking about the stock market. And this week, he's going to teach us how to beat the banks at their own game and use them to pay off your mortgage faster. David, welcome back.
Hi, Ray.
Welcome back.
Hi.
Hi.
Greg, how are you going?
So,
Molly, I should say.
We had a great response from last week's show.
Thank you.
Which is great.
Yeah.
Yes.
It's one of my goals is to really purpose in my life to get people more financially savvy and making sure they do the best with the resources that they have.
Absolutely, and as a stock market timer and the bell ringer, according to the Australian Financial Review, you have been featured in a lot of different places where people ask for your asset license expertise to time the share market and what to do and how to do it and when to do it with the stock market. Isn't that right?
Yes, yeah, and that's what I do day in, day out. I have a group of people who are called the profit hunters, and they ask me what shares they could buy or what shares they could say to their customers to buy in the case of financial advisors. And I also tell them when to get in, when to get out, how far that share should go to, and what time it should take to get to that stock market high or share price high.
So just quickly, how did you develop that expertise?
35 years worth of doing this, just like you as a presenter. You've been doing this for a long time. I would imagine you do it very well. Yeah. And so, I'm a specialist in this area, and I've been charting. I was managing currencies for Qantas. I was the foreign exchange manager for Qantas, treasury manager. I was managing the interest rate risks and hedging risks on the US dollars for an Australian satellite company. I've also been trading for Macquarie Bank and trading on the bank's money as well, being a fund manager with $4.5 billion under management. So this has been my career, my speciality, and you know, the more you specialise, the better you get at it.
Yeah, absolutely, and that's what gives David the expertise to actually call the markets and time it and tell people when to get in, when to get out, when to buy, when to sell, and what to buy and sell.
So it's a big topic, which is beating the bank at their own game.
Yes, it is.
Please tell more.
Okay, well, I want to give you a secret. If you're a shareholder in the banks, don't tell the banks this, if you're a shareholder in the banks actually pay shareholders higher percentage dividends than they charge their customers who have mortgages. So as an investor,
I want to reinforce that.
Yes,
can you just say it again?
Yes, please.
Okay, I'll give it to you in numbers. A mortgage costs 4.5% at the moment, on average, and the bank dividend
as in
rate,
interest, the
as
interest rate that you
interest
pay,
rate that you pay, and the bank dividends to shareholders currently sits on average around about 5% on the minimum side against the share price. So in effect, shareholders earn a better return than mortgage holders pay. So the banks, by virtue of their fixed fractional reserve banking, can lend out lots and lots of money, and they make lots of money in different places, having high credit card interest rates, high mortgage rates, low deposit rates of 1%, bank fees, and so all the mix comes to so that shareholders actually have a higher return than they can pay on their mortgage.
Wow,
so you're better off if the share price stays still. You're better off investing in the bank share and receiving dividends.
We have to break this down for some of our viewers that may not have watched our previous episode where we talked about the stock market and how it works. So can you just give us a really brief recap about what stocks are, what is the stock market, how does it work, what does it mean to be a shareholder, and what are dividends?
Okay, let's start with dividends. Dividends are what banks pay you out of their profits, and it's kind of like if you bought a house and you were receiving rent, you were an investor and you received rent. Dividends are like that. What you get is after the net dividends, and you've paid interest. Maybe you've paid interest. Maybe you've paid expenses and tax, paid landlord fees and rates and all those sort of things. That's your profit. So that's what you end up at the end of the day. And the banks like what you get into your bank account when you're a cash positive mortgage investor. Yeah. And when the banks, when they've got the dividends, they say, okay, right, we've made $6 billion. We want to give $5 billion to our investors, and they're those people who own parts of the business, which is your share. And
as
then,
shareholders.
As shareholders.
Yes.
And because the banks have paid tax on those shares, the government says, right, because the banks have paid tax on the dividends and the profits, the dividends come what is called fully franked, which means that when you're on a reasonable tax rate, on a high tax rate, you will get a positive flow back from the government. You'll get a tax credit if you're if you receive fully franked dividends or even partly franked dividends.
Great.
Anything positive is good.
Yeah, absolutely. Anything that gives us more money to pay off our mortgage or save for a deposit for a house or plan for retirement, isn't that correct?
Yes,
absolutely.
So to recap and summarize, if that's okay with you, the stocks are what you get when you buy a part of a company. Is
yes.
that
you have an ownership?
You have
a part ownership.
of that with your shares, and you trade it in a place called the stock market,
yes.
which is regulated by the government and ASIC, yes. The Australian Securities Investment Commission.
Yeah,
is that correct?
Yeah.
And when you buy shares in certain places like banks, you can get dividends, which is what the banks give you when they make a profit.
Yes.
Wonderful. And that's how, if you have dividends and you can also make more money buying and selling the shares itself, you can actually pay off your mortgage faster with it.
Yes. So if you get if the price goes up, that's called a profit.
Yes.
Or a capital gain if you hold it for more than a year, and after more than a year you receive a tax credit or a tax benefit by virtue of the fact that you only pay tax on 50% of that gain. So there's a lot of advantages for holding shares at the right time and at the right price.
So that's a strategy we need to explore, which is all about using the stock market to pay off your mortgage a lot faster.
Absolutely.
I love it.
Yes, absolutely.
What this show is all about.
And then we can talk more about that after the break.
You're watching the Mortgage Busters show. David, how do we beat the banks?
How do we beat the banks? Well, what it is I've created a strategy where you look for the right time to buy the banks when they're paying dividends. Before they pay dividends, you want to get into those shares because there's a positive effect where the share gets higher as people buy into this share before they pay the dividend. And then what we look to do is we want to make sure a couple of things happen. We want to make sure that one, the bank can pay a dividend and it has the right business, and that will pay a fully franked dividend, because there's a thing called a tax credit, a fully franked tax credit that happens when the banks have paid their tax.
And the ATO then reimburses
and the ATO gives you a credit for that, and then you can apply that in your tax, and that grosses up the yield that you receive for investing. So we also want to make sure we want to buy it at the right price, so the price you pay is not too high. And we also want to make sure our entry and exit strategies are well defined.
So there's a lot that needs to be made sure there in that dialogue.
Yes.
Certainly, the crucial point is the bank will pay a dividend. And that always makes sure that you're looking at a bank that will pay a dividend. And there's one bank which I will not touch. I believe there are other better banks to do. And
because they make money.
Because they make money.
If they make money, shareholders make money.
Yes, there's one bank that's having problems with paying its fully franked dividends at the moment, and I would stay away from that one.
Yeah.
The great news is, there are two banks coming up in July and August that are about to go into this phase that we call the dividend buying zone, and and we'll talk about those ones in a little while when we go through the strategy. So.
Absolutely, because you have something very exciting to share with our viewers, and it's David Hunt's special mortgage busting formula: how to use the bank's own money to beat them at their own game and pay off your mortgage faster. So,
Beautiful.
David.
Okay,
let's go to the whiteboard.
Let's go to the whiteboard. So, most people have a mortgage. The day I paid off my first mortgage was the best day I ever had, and it took me 9 years. I worked and worked and worked on it, but it was just absolute freedom having that. A mortgage, at current mortgage rates, around about 4.5%. Post-tax, if you're an investor, that means you get a tax credit on your deduction of the mortgage, and it costs you about 3% after tax to service that mortgage. Now, many of us use an offset account, and this is the thing that I would say is the most important thing that you can use.
Absolutely.
To create flexibility, because if you pay off your mortgage, the money's gone. You have to redraw it, deal with banks might maybe want to reduce it, but the offset account gives you the freedom to move money in and out. And effectively, if you put money, $1 into an offset account or $1,000 into an offset account, for every $1 or $1,000 you put it into the offset, the mortgage is negated by 4.5%. So effectively, it's the same rate.
Yes.
So 4.5% is your return for having money in the mortgage offset account. Post-tax, because you've reduced you've reduced the deduction you get, that's a return of 3%. So
that means you're actually ahead, doesn't it, David?
On this one?
On having an offset account, every dollar and every $1,000 you put in reduces the mortgage by $1,000 at 4.5%,
Yes.
the same rate that you're paying
Exactly.
interest on.
And now what happens is the banks use your mortgage to have the power of compounding. In other words, every month they'll charge you 4.5%, and if you don't pay that, then they compound it by 4.5%. So your effective cost is much greater than that. So money in the offset account is really worthwhile. And that's why when we use the strategy that I'm going to talk about, we don't want to do this all the time. We only want to do it at certain times with our money, so that we're using the offset at the right time for as long as possible, and using the strategy in bank shares.
Yes.
So you're going to tell us the right time.
Absolutely. And you're going to, and sometimes, if that's okay with you, just very briefly, just for our viewers' sake, an offset account, if it has money in it, it will reduce the amount of interest they have to pay.
Yes.
And now you're going to tell us how to use bank shares.
Yes.
And when do you take money out from your offset account to buy these bank shares?
Yes, the money comes out and flows in and out of the offset account. So
thank you.
So what we're looking to do is we're going to move the money from the offset at the right time, and we'll talk about the right timing later. And the banks are currently giving a dividend of about 5% per annum. Some are less, so around about the lowest is about 5%, some are 6%. Because of the franking credits, it's returning somewhere like 7 to 8% after tax. If you look up here, we've put post-tax in these columns. Red is negative, black is positive. So 7 to 8% post-tax return. And when you look at this, if you ship money into bank shares at the right time, and so that there's no risk or less risk of the share price falling, that 7 to 8% return is now something like 4 to 5% better than you would have paid for the mortgage.
So do all shares offer franking credit?
No, not all shares do, and the banks are one of the best source of franking credits there are in Australia. Some other miners, they've, for example, BHP and Rio were paying very good dividends because of the mining boom. And when the mining boom finished, they've started to reduce their dividends just this year. So the banks are the best and most certain form of dividend dividend supply, plus they also have less volatility than, say, mining shares.
Yes.
So that's why I choose particularly the bank shares. So the bank shares, we're using their own money, the money that they've lent to us, to invest into bank shares to get a bigger return, both pre-tax by 0.5% and post-tax by some 4 to 5% at the right time.
So does that mean you're 4 to 5% ahead of what you owe the banks?
Yes.
Wow.
Yes. And then when that dividend process is finished, you put the money back into the offset account, and then it works from there. So then you continue on with the offset.
Wow, that is brilliant. So you can actually, but you would only use the money in your offset account if you have a minimum of 3,000 to 5,000 in order to buy into these bank shares to cover costs and things like that. Is that correct?
Depends on the cost that you use. Some brokers, such as Ideal, have about a $12 minimum charge for up to, I think, about $10,000. ComSec has a charge of $19.95. So,
sorry, David, would you mind if we just continue? This is all great information, but we need to go to break. So apologies. So we'll just be back. We'll be back after the break.
You're back with the Mortgage Busters. David, just to summarise what you've put up here on the whiteboard, you've got the mortgage, the next level to improve that situation is the offset account, and then bank shares.
Yes.
So just to summarise?
If you've got an offset account, it's giving you 4.5% pre-tax and 3% post-tax return. If you own bank shares and at the right prices, you are receiving 4 to 5% above what the mortgage offset is giving you, post-tax.
So at the right prices
At the right
and the
prices,
right timing.
At the right timing.
Okay, but that's where you're expert.
Yes.
Of course.
And as the expert, you get that kind of return, 4 to 5% over a year, but you can get that in a less period of time.
Yes, you can, because there are certain times where the banks pay dividends. Banks pay dividends at different times.
Right.
The next two banks to pay are Westpac and CBA over the coming 2 months, July and August. So what we are looking for is to time the entry on those banks, to take the dividends, to receive the franking credits, and then sell those shares, and then walk away and put that money into the offset again, and look to find the next bank that will pay the dividend.
As long as what the rate that we buy the shares at and the rate that we sell
That's correct.
The rate that we sell is higher than the rate we buy, and we get the dividends, then we get the win-win situation, the best of both worlds, and we put that money back into our mortgage and pay it off faster.
And yes, and that's exactly right. It's that strategy. With the right price, that's the work that I do with my Profit Hunter Group members, and for people who come along to the webinars that I do as well.
Oh, wonderful!
So
you tell us when.
Yes, so I work on that timing when. And so, would you like to see the steps that people could take for themselves to make sure they can do this?
Please, Greg.
Greg, if you'd like
Let
to
me
do
help
the
you flip the board. There we go.
Thank you very much, Greg.
Ooh. There
Wonderful. We have some steps to follow.
Okay,
now.
these are the steps to follow. Firstly, number one, we want to make sure that the business is good and that we can get fully franked dividends from that business. So in this case, we're looking at banks, and CBA is one of the best ones for fully franked dividends. Westpac is the next one in terms of businesses. NAB is kind of a little bit, not quite as good as Westpac and CBA. ANZ, they're having problems getting fully franked dividends. They had to do some magical things with their accounting to get them. So ANZ is not the stock to be that excited about for this strategy. And then the next time we've got to look at the timing of the market and the banks. So what are the cycles in the current market? What is the current bank stock price cycle to determine when it's reaching a low and when it's close to those dividend payment times. So as it moves into the payment time, we want to pick up the right area, the right timing, and then we want to look for the best buying in price for that bank, so that we can control our risk, and if things go wrong, we can get out quickly.
Yes.
Okay? So that's the best price. We want to buy a bargain in this time cycle. So we keep an eye on what the bank is doing, what the market's doing. We keep an eye on what the business is.
Everybody loves a bargain.
Yes.
And we want to have a bargain basement sale going on in the banks.
Just a quick thing, David. One of the best things about the stock market is something called a stop loss. Isn't that correct?
Yes.
It actually prevents you from losing too much money.
Yes, and they can be automatically adjusted.
Yes.
Selling a house might take you 6 weeks to market, or 4 weeks to market, and it might take you 6 weeks to settle. In Victoria, it's 4 weeks, and in New South Wales, it could be 6 weeks. So it's a very long time to sell a house. A house is an illiquid thing, whereas a share is very liquid. At 9 o'clock in the morning, I can ring up my broker and say, sell, or I can go into the CommSec account at 9:59 and I can sell at 10 a.m. in the morning the share that I'm not interested in, as long Monday to Friday. It's not quite that easy with a house, so or a property. So the first thing that we're looking for the best buy price, and then we're looking for a good entry strategy. And the entry strategy works around the best buy price, but you'll have to also take into account maybe you won't get the best buy price. You might find that the bank is stronger, the share price is stronger than you thought, and it doesn't quite get down there. So I work an entry strategy for that.
Okay.
And the entry strategy is based around the timing, the best buy price, plus also the psychology and the patterns in the market. The exit strategy depends on how the bank works. So if the share price goes up into the dividend payment date, you receive the dividend, you get your fully franked dividend, and you've held it for the required 45 days for tax reasons if you've got $5,000 or more in franking dividends. That's dividends $5,000. A little bit technical, we'll talk about that later.
We've got about 1 minute.
We've got about 1 minute. And then you have the exit strategy. And sometimes, if the share price has really gone to the moon, on a skyrocket, you might not want to exit that share. So you could hold that as an investment, and it will pay you those high dividends and give you capital gains.
Wonderful.
So we've got a minute or so, just to summarise in terms of the share market paying off the mortgage, in one sentence.
If you've got a mortgage and an offset account, you can invest in bank shares, and and also a couple of other bank preferred shares that give you even higher rate than shares themselves with fully franked dividends. And there you can increase your returns, get capital gains, and then plough the money back into your mortgage offset account, which reduces your mortgage.
Fantastic.
That's wonderful, but it's a lot of really technical stuff that our viewers have to know. Isn't it easier if they just come to an expert like you who is ASIC licensed to tell them what to do?
It is in many ways. Yes. It is, yes, and I do educational programs on these. And June 21st, I'll be doing a webinar on the banks, specifically on the banks, and have a look on the website. You can see that and join in. It's free for people interested.
Absolutely.
And educational. It gives you the market timing, and we'll be looking specifically at the next dividend paying bank.
Yes, fantastic. And we can get our viewers onto you for
that. Thanks so much for having us again, or for being with us again, and for last week as well. It's been very enlightening today and last week. Wonderful.
Yes,
thanks again.
Rain,
just to finish off, just quickly, the thumbprint report.
The thumbprint report is available for free, and any of our viewers can contact us on 1300-862-746 to request a free copy of the thumbprint report.
You've got to please tell me that number again.
Of course. 1300-862-746. So you can call us for this free thumbprint report, or to join in the webinar that David was speaking about on his special Profit Hunters group. Thank you.
You've been watching the Mortgage Busters show, and we'll see you again next week.